Greetings, everyone. Scott Richardson, Dan Brown from Richardson Capital Management, here to present the third quarter 2025 economic and investment update. And I would say the good news is we have a lot of positive things to share as the financial markets performed very favorably during the quarter and during the month of September. Stocks have been up for 5 months in a row, so all 3 months during the quarter. And fixed income also performed favorably as interest rates declined and the values of fixed income went up during the quarter. And the other good news is the fact that the gains, while information technology has led the way again, have been pretty broad based. So it wasn't like there was one sector or a handful of stocks leading the way, and we've had pretty solid growth throughout all the different industries. So pretty positive results for the quarter. And I guess the real question then would be, hey, what's caused this strong performance? And I guess from our perspective, we're probably looking at four or five things. First thing probably what you say, Dan, is maybe the corporate earnings came in pretty darn strong again. Companies have continued to show they can grow earnings at upper single digits to lower double digit returns, which is fantastic. And then you couple in the fact that, there's been major concerns with the tariffs during the course of the year. And to date, they haven't materialized. It's not to say that they won't show up maybe later on during the year, but as of now, tariff impact really hasn't had a negative impact. So you got those as two big positives. And there's probably a couple more, would you say, Dan?
Yeah, so let's go back to earnings for a second. So we continue to see very strong corporate earnings. We're about to enter third quarter reporting season for
Mhm.
earnings. Outlook still looks very strong, as you mentioned, high single digits, low double digits. And that again, the outlook looks very strong from our point of view. And one of the themes that's driving corporate earnings is this whole artificial intelligence theme, the AI theme. And want to point out that it's pretty broad based. So it's not just information technology that's leading the way. That spillover effect is occurring in other sectors.
Yep.
So we see it occurring in other sectors like utilities because there's demand for power to power
Mhm.
all the data centers. The data centers are being built by the REITs or the real estate investment trusts. So a lot of real estate companies are benefiting from that. And then what goes into the data center is just a lot of electronic components.
Components.
So
Yep.
we see a lot of industrial companies, for example, benefiting from that spending. So that spending, again, it's not just related to information technology, it's broader and deeper than that. And the thing that we'll touch on in a second here is just, Fed rate cuts. I think investors correctly anticipated the Fed rate cuts at some point later this year, and we're there finally. So I think a lot of those positive returns from the Fed rate cuts were baked in at some point during the third quarter.
So, Dan, you mentioned the Federal Reserve and interest rates. So, the Federal Reserve Board met this month. They made a decision to cut rates for the first time in several months. Walk us through kind of what we gained from the comments and kind of what the outlook is going forward for interest rates, obviously, as a key driver.
Yeah, so as I mentioned previously, a lot of investors were anticipating the Fed would cut rates sometime in the third quarter, fourth quarter. And sure enough, at the September meeting, the Fed finally got off of pause, which
Yep.
they had been in pause mode, all year, and cut the Fed funds interest rates by a quarter of a point, bringing the current rate to 4 to 4.25. And just to review how we got here in this cutting cycle,
Mhm.
so the Fed started cutting the cutting cycle last September, so September of 2024, and they cut interest rates by 0.5%, and then another quarter point in November, and another quarter point in December, and then had been on pause this year until September because they were worried about the effects of tariffs leading to a surge in inflation. And we
Yep.
really haven't seen that surge in inflation. So the Fed finally felt comfortable going ahead with another rate cut in September. And their comments at the Fed meeting were particularly interesting because they, for the first time, talked about the weakening labor markets as being their top concern. So previously, their top concern was a surge of inflation
Yep.
caused by the higher tariffs. Again, that really hasn't materialized, but the labor market in the meantime has weakened quite a bit the past few months, and they noted that that is now their top concern. So we not only see a slowing labor market with the monthly Bureau of Labor Statistics report, which is the official government report, but other private measure surveys. And then we also see things like weekly unemployment claims weakening, the unemployment rate going up modestly. So we feel that is a fair concern, and that should be the Fed's top concern. So that should lead to further rate cuts later this year and into 2026. So the graph that we're showing here just shows that path that we talked about for the current Fed rate cuts. And then the dotted line is the outlook for the remaining quarter for this year and then for all of 2026.
Mm-hmm.
So the thing that's probably worth pointing out is the Fed at the end of their meeting publishes their projections. So those projections are being shown here on the graph with that gold colored diamond at about 3.25% for December of 2026. But then if we look at what's being priced into the market by investors, we can, observe Fed funds futures contracts to derive those outcomes. We see that investors are expecting a little bit more in the form of rate cuts. Probably not a huge difference right now, nothing to be concerned about, but again, a slight difference there. And our overall take on Fed funds, the outlook for Fed funds, that is that the Fed is moving out of restrictive territory and into more of a neutral policy for interest rates. And we think 3.25 by this time late next year makes sense. And again, the labor markets are weakening, so we think further rate cuts are in store in this cycle.
So Dan, thanks for the update on the Fed. So turning the page and kind of looking forward, the question is what's the outlook looking like? And I'd say from our perspective, there's, as you alluded to earlier on, there's a lot of positive things still working in our favor here. Corporate earnings, we're continuing to expect to be pretty strong going into the third and the fourth quarter here. I'd say the path of interest rates still remains pretty positive unless we see something significant that would slow down the Fed. But barring that, we're feeling pretty good with the interest rate environment. The environment for corporate spending should improve and continue to improve. The tax law that got passed has major incentives for corporations to be able to deduct capital expenditures. So we're expecting some good capital expenditure growth. And continued enthusiasm behind artificial intelligence and the growth in technology and how it's going to impact the world. It seems like an awful lot of positives, but obviously there's a couple things we got to keep our eye on, and maybe you want to cover a couple of those things we're a little concerned with.
Yeah, one of the negatives that we're paying attention to is this government shutdown that's looming in early October. And as we sit here in last day of September, it appears as though the government shutdown is very likely, but we don't expect it to have any longer term negative impacts to either the economy or the financial markets.
Right.
So we've had numerous instances that we've looked at for historical data, and for the most part, investors look through the shutdown because they realize it's going to be temporary. And again, there hasn't been any drastic impact to either the financial markets or the economy, but it could certainly introduce some short-term volatility.
Yep.
And again, we've had 5 consecutive months of positive stock returns. It's very possible we see a little bit of a give back here with some headline risk around the government shutdown.
And then Dan, what about like upside potential from here, given where valuations are? I mean, should we temper folks' enthusiasm? I mean, probably getting the returns we've achieved so far in the first 9 months probably isn't sustainable for the duration, I would think.
Yeah, the returns we've seen for the first 9 months, very strong. So where does that leave us from a valuation standpoint? Valuations are historically expensive. So it's hard to see further upside in multiples. So for example, the PE multiple expanding further from here is sort of limited. So we're going to have to see that earnings growth really come through. So we talked previously about earnings growth expectations for this year, high single digits, low double digits. If we continue to have that come through for the third quarter and fourth quarter, there probably is a little bit more upside. But again, we think most of the returns for the year, for the most part, have been earned already here in the first 9 months.
So with that, that's going to wrap things up for this update. But I want to, one, let everyone know that if you have any questions or concerns, please don't hesitate to reach out to us. Also, want to let everybody know that we truly appreciate all of the continued trust and support that you've been showing all of us, and we look forward to hearing from you soon.